Hey everyone, in this video I'm going to bring to your attention one dividend stock that's down 57% that I think you might regret not buying on this dip. But before I tell you which dividend stock this is, I'm going to highlight some of its financial metrics, talk about why I like the stock, and then towards the end of the video I'll reveal what this dividend stock is. So let's get right into it. Starting with, of course, the dividend yield. If you're investing in dividend stocks, one of the most important things you're looking at is the dividend yield. This one boasts a relatively strong dividend yield of 4.02%, right about what you can get with a 10-year government bond interest income. But with the dividend payment, you can reasonably expect the dividend payment to increase over time. Whereas with the government bond, you get the same payment every quarter, every year, or whatever your payment terms are. At least with the dividend stock, you have the potential for dividend increases. Although on the downside, investing in a dividend stock, you also have the potential that maybe the stock price falls in your investing time horizon, which could take away from your total return. The next thing I wanted to highlight about this stock is the revenue. Look at the trailing 12-month revenue here. And in the most recent trailing 12-month period, it generated 24.94 billion. Another thing you notice here is the big fall and recovery, the big V shape here in the middle, demonstrating that this company was devastated by the pandemic. Revenue crashed, of course, as it was forced to close many of its brick and mortar stores when the government ordered non-essential businesses to shut their doors temporarily. However, during that time, the company made some adjustments to the business, cut costs, streamlined operations, which has allowed it to come out of the pandemic stronger than ever before. What I have shown here is its cash flow from operations to sales. The 5.9% in its most recent trailing 12-month period is right about where it was before the outbreak. However, there are several reasons why I think it could be better going forward. Number one is an adjustment to its online sales model. Previously, this company was only selling inventory that it owned on the website. Now it allows third parties to sell on the website, which allows for the company to generate stronger cash flow, because when you buy inventory, that reduces your cash flow, right? Because you got to spend money to build up the inventory, and then when it sells, the cash flow comes back, but then you got to reinvest in more inventory, and so on and so on. But if you allow third parties to bring items to your platform, you increase selection without decreasing cash flow. So I think that's a favorable move. Also, that's increasing visitation to the website, which has allowed this company to increase ad revenue from the website, which is an incredibly lucrative form of revenue for a retailer because it has no cost of goods associated with it. It's purely profit, so very high profit margins there. Going forward, I foresee strong, well, I shouldn't say strong, I should say good to strong growth here in terms of cash flow from operations from this company. Finally, what I like about this company, the final thing I will note, is the attractive valuation. It's trading at a forward price to earnings of just 5.1. Just 5.1. It's one of the cheapest stocks in my coverage. It's one of the cheapest stocks that I follow. And yes, it's cheap for a reason. It's not going to grow revenue very quickly. It generates most of its sales from brick and mortar stores, which are not doing so well in the last decade as people are spending more money online and so on. So it's not supposed to sell at an expensive valuation, but I think at 5.1, I think it's a bargain. I think it's a relative bargain, especially for dividend stock investors who are looking for that passive income. This stock does a good job of that. So what is this stock? Is Macy's. Macy's is the dividend stock that's down over 50% off its high that I think investors might regret not buying on this dip here. All right, but that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.